Shanghai is paying $9.39 more per ounce for silver than the Western price. Right now. Today. That is a 12.31% premium. And the arbitrage is not closing. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Something is structurally wrong in the silver market. The data is already telling you exactly what it is. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. The Shanghai Gold Exchange. Silver closed at $85.69 per ounce on April 10, 2026. Western COMEX spot closed at $74.38. That is a $9.39 gap, a 12.31% premium. The 6-month average premium is running at $6.47 per ounce. Current levels are above the already elevated trend. This is not a one-day anomaly. This is not seasonal noise. This is a sustained structural divergence between three separate pricing systems. COMEX paper near $74, London physical basis above that, and Shanghai physical at $85 and holding. The timing is what deserves scrutiny, not the number itself. The timing. 3 markets, 3 prices, 1 metal. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time Western silver coverage ratios were this low, silver repriced by multiples within 24 months, the data is already telling you something. Let's build it out. Now let's build the full picture, because the Shanghai premium does not exist in a vacuum. COMEX registered silver, the only inventory immediately available for physical delivery against outstanding futures contracts, stands at 76 million ounces. Blowfin Research confirms this figure as of late March 2026. Total open interest on COMEX silver sits at 576 million ounces equivalent. That is a coverage ratio of 13.4%. Below 15% is the threshold that CME Group exchange analysts formally classify as stress territory. 13.4% is below that threshold. Right now. Today. In the past 30 days alone, 1.5 million ounces, 1.9% of registered inventory, have been withdrawn from COMEX vaults. The rate of drain is not slowing. It is compounding. The gold-silver.ai COMEX stress index, which combines coverage ratio, inventory trend, paper leverage, and vault outflows into a single score, is elevated. The Silver Institute projects a 6th consecutive annual supply deficit in 2026 of approximately 67 million ounces. China's silver imports hit their highest level in 8 years in early 2026. That is sourced from Silver Institute official reporting. The data is doing the talking. The ones who have been called alarmists for flagging the physical paper divergence in silver, they are not saying much right now. And here is what makes that picture even harder to ignore. The arbitrage between Shanghai and COMEX should not be this wide. Shipping costs for silver between markets are approximately $1 to $2 per ounce. The spread is 9.39s. The math says traders should be buying silver on COMEX, shipping it east, and collecting the profit. They are not doing that. The reason is structural. When traders attempt to pull physical metal from COMEX to ship eastward, they encounter a registered inventory that covers just 13.4% of outstanding paper claims. The metal required to close the spread is not freely available. COMEX operates on the foundational assumption that the vast majority of contracts settle financially. That assumption is being stress-tested right now in real time. At the same time, the DXY dollar index is at 99.02, recovering sharply on Monday's Hormuz blockade announcement. The 10-year Treasury yield is holding at 4.29 to 4.32%. Federal Reserve rate cut probability for 2026 sits at 0%, confirmed by CME FedWatch data. Those macro variables are applying direct downward pressure on COMEX paper silver. Western paper markets are pricing monetary policy risk. Eastern physical markets are pricing metal availability. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about right now: 20%. That is the share of global daily oil trade that passes through the Strait of Hormuz. As of April 13, 2026, U.S. Central Command has announced a naval blockade of all Iranian ports, effective 10 a.m. Eastern Time today. Islamabad peace negotiations between the U.S. and Iran collapsed on April 12th. J.D. Vance departed without a deal. West Texas Intermediate crude gapped up 7 to 8% at Monday's open to approximately $97 to $104 per barrel. The International Energy Agency has called this the largest oil supply shock in the history of the global oil market. March CPI printed at 3.3% annual, the highest since May 2024, sourced from the U.S. Bureau of Labor Statistics. Core CPI came in at 2.6%. Markets are still pricing a soft landing resolution. Look at WTI above $97 and tell me what probability you put on that assumption holding. When markets start pricing the reality of sustained energy disruption, real yields move higher. The dollar strengthens further. Non-yielding assets face continued mechanical pressure. That is the historical pattern. Every time energy supply has been disrupted at this scale and duration, it has not been different yet. Silver Western spot at 73.80, session opened at 75.90. That is a 2.76% Monday gap lower, confirmed at the Asian Open. Shanghai last quoted at 85.69. The premium is 9.39. Short-term picture, the DXY at 99.02 and the 10-year yield at 4.29 to 4.32% are the dominant variables. If the dollar holds above 99 and yields remain above 4.25%, Western paper silver faces continued pressure towards $70 to $71 technical support. If the Hormuz blockade produces diplomatic off-ramp language within 48 hours, oil retreats, inflation expectations ease, and silver reclaims the $76 to $78 range rapidly. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. This is a confirmed gap event session with live geopolitical escalation and a zero rate cut probability environment. That combination does not produce clean entries. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY strength above 99 continues to suppress dollar-denominated silver mechanically. Zero probability of a 2026 Fed rate cut removes the primary macro tailwind for non-yielding metals. Speculative long liquidation on continued energy-driven inflation fears could push Western spot towards $68 to $70 before physical demand creates a durable floor. The bull case is equally real. COMEX registered silver at 76 million ounces covers just 13.4% of 576 million ounces of paper claims, formally in CME-classified stress territory. Shanghai's 939 premium over COMEX represents a 12.31% divergence that arbitrage cannot close because the physical inventory is not there to move. The Silver Institute projects a 67 million ounce annual supply deficit in 2026, the sixth consecutive annual deficit, with China's silver imports at an 8-year high. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure in silver is already built and documented in real-time data. The only open question is when the paper market reprices toward what the physical market in Shanghai is already pricing at 85.69. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. Don't take my word for it. Verify every number I gave you today. Check the data yourself. goldsilver.ai for live COMEX registered inventory and Shanghai premium data. CME Group official daily metal stocks report at cmegroup.com for registered and eligible silver figures. Silver Institute at silverinstitute.org for the 2026 annual supply deficit projection. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.